Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most traders approach the market with a fixed idea. They believe that if they can just find the right strategy, something consistent, something repeatable, then success will follow. This is one of the most dangerous assumptions in trading, not because strategies do not work, but because no strategy works across all conditions. Markets are not static. They are not stable systems. They are dynamic, constantly shifting environments driven by liquidity, sentiment, macroeconomic forces, and participant behavior. What works in one environment will often fail in another. This is the core concept of market regimes. A regime is simply the prevailing set of conditions that define how the market behaves at a given time. It determines whether trends persist, whether volatility expands or contracts, whether mean reversion dominates, or whether momentum takes over. Professional traders do not start with strategy. They start with environment. They ask a simple question: what kind of market am I operating in right now? Because the same setup, the same chart pattern, the same signal can have completely different outcomes depending on the regime. A breakout in a trending environment can run for days. The exact same breakout in a range-bound environment will fail within minutes. Retail traders often interpret this as inconsistency in their strategy. In reality, it is inconsistency in their understanding of context. Markets shift between different states, and those states dictate probability. If you ignore that, you are effectively trading blind. Think of it like this: you would not apply the same driving technique in heavy rain as you would on a dry road. The conditions change how you operate. Trading is no different. The mistake is believing that markets reward static thinking. They do not. They reward adaptability. Understanding regimes is not about prediction. It is about alignment. You are not trying to forecast the market's future. You are trying to identify its current behavior and position yourself accordingly. Once you begin to see markets through this lens, everything changes. You stop asking whether a strategy is good or bad. You start asking whether it is appropriate for the current environment. That shift alone separates amateur thinking from professional thinking. To understand market regimes properly, you need to break down what actually drives them. Regimes are not random. They emerge from underlying forces that shape market behavior. At the highest level, there are three primary drivers: liquidity conditions, volatility structure, and directional bias. Liquidity determines how easily capital flows through the market. When liquidity is abundant, markets tend to move smoothly, trends develop more cleanly, and risk assets often perform well. When liquidity tightens, movements become erratic, spreads widen, and risk appetite declines. Volatility reflects the intensity of price movement. It is not just about how much price moves, but how it moves. Low volatility environments tend to be stable, often characterized by grinding trends or tight ranges. High volatility environments are unstable, with sharp moves, reversals, and increased uncertainty. Directional bias is about whether the market is trending or not. Some environments are directional, where price moves consistently in one direction. Others are non-directional, where price oscillates without clear progression. These three drivers interact constantly. They create the conditions that define how the market behaves. For example, a high liquidity, low volatility, directional environment is typically ideal for trend following strategies. Price moves steadily, pullbacks are controlled, and continuation is more likely. In contrast, a low liquidity, high volatility, non-directional environment is chaotic. Price moves aggressively but without structure. In these conditions, trend strategies struggle and mean reversion becomes more viable, although still risky. The key insight here is that no single variable defines the regime. It is the combination that matters. Most traders oversimplify this. They label markets as trending or ranging and stop there. That is insufficient. Two trending markets can behave very differently depending on volatility and liquidity conditions. Professional traders go deeper. They assess the full structure of the environment before committing capital. This is why institutional frameworks place so much emphasis on context, because without context, signals are meaningless. You are not trading a pattern, you are trading the environment in which that pattern exists. Let's now look at one of the most critical regime distinctions in trading: trending versus mean reverting environments. Trending markets are characterized by persistence. Price moves in one direction with relative consistency. Pullbacks occur, but they are typically shallow and temporary. The dominant force is continuation. In these environments, momentum strategies thrive. Breakouts tend to hold. Higher highs and higher lows, or lower lows and lower highs, form clearly. The path of least resistance is aligned with the direction of the trend. However, trending environments are psychologically difficult for many traders because entries often feel uncomfortable. Buying high or selling low goes against natural instincts. Traders hesitate, miss moves, and then chase late, which often leads to poor execution. Mean reverting markets are different. Price oscillates within a range, moves extend then reverse. Extremes are often rejected, and the market spends most of its time moving back towards a central value. In these environments, reversal strategies work better. Selling resistance and buying support becomes more effective. Breakouts are more likely to fail, leading to false signals and traps. The challenge here is that mean reverting markets can feel easier to trade, but they require precise timing. Entries need to be accurate, stops need to be tight, and discipline is critical because overextending in a range can quickly lead to losses. The critical mistake traders make is applying the wrong approach to the wrong environment. They try to trend follow in a range, getting chopped up repeatedly, or they try to fade moves in a strong trend, stepping in front of momentum and taking unnecessary losses. This is not a strategy problem, it is a regime recognition problem. Your job as a trader is not to force the market into your strategy, it is to adapt your approach to the market. Once you understand whether the environment is trending or mean reverting, you immediately filter out a large number of low probability trades. That is how professionals think, not in terms of opportunity, but in terms of suitability. Another critical dimension of market regimes is the distinction between risk-on and risk-off environments. This concept is rooted in macroeconomic behavior and global capital flows. It reflects how investors collectively respond to uncertainty, growth expectations, and financial conditions. In a risk-on environment, investors are willing to take on more risk. Capital flows into equities, commodities, and higher yielding assets. Growth expectations are positive, liquidity is supportive, and sentiment is generally optimistic. Currencies associated with growth and yield tend to perform well in these conditions. Assets that benefit from economic expansion attract capital. In a risk-off environment, the opposite occurs. Investors prioritize safety and capital preservation. Money flows into safe haven assets such as government bonds and defensive currencies. Volatility often increases and risk assets come under pressure. These shifts are not random. They are driven by macro factors such as interest rate policy, inflation dynamics, geopolitical risk, and economic data. Understanding whether the market is in a risk-on or risk-off regime provides critical context for trade selection. For example, attempting to buy risk-sensitive assets in a risk-off environment introduces structural headwinds. Even if the technical setup looks strong, the broader context works against you. Conversely, aligning with the dominant risk regime increases the probability that your trades will follow through. This is where many traders fail. They focus narrowly on charts and ignore the macro backdrop. As a result, they enter trades that are fundamentally misaligned with broader market flows. Professional traders integrate both. They understand that price action reflects underlying forces, and those forces are shaped by the macro environment. Regimes are not just technical, they are structural. And if you ignore structure, you are trading without a foundation. Volatility cycles are another essential component of market regimes, and they are often misunderstood. Volatility is not constant. It expands and contracts over time, moving in cycles. These cycles influence not just how much the market moves, but how trades need to be structured. In low volatility environments, price movements are more contained. Trends may develop slowly, and breakouts can take time to gain traction. Stop losses need to be tighter, and position sizing can be more aggressive because the range of movement is smaller. However, low volatility environments can also create complacency. Traders become comfortable with tight ranges and stable behavior. When volatility eventually expands, they are often unprepared. High volatility environments are very different. Price moves rapidly, ranges widen, and uncertainty increases. In these conditions, risk must be managed more conservatively. Position sizes should be reduced, and stop losses need to account for larger price swings. The mistake many traders make is treating volatility as an afterthought. They focus on direction, but ignore how the market is moving. Direction without volatility context is incomplete. A strong directional move in a high volatility environment behaves very differently from a similar move in a low volatility environment. Professional traders adjust their execution based on volatility. They understand that the same trade idea requires different risk parameters depending on the environment. Volatility is not just a measure, it is a condition that defines how you operate. Ignoring it leads to poor risk management and inconsistent performance. Market regimes are not permanent. They transition over time, and recognizing these transitions is one of the most valuable skills a trader can develop. Most losses occur not because a trader fails to identify a regime, but because they fail to recognize when it has changed. A trending market begins to lose momentum. Breakouts start to fail. Volatility shifts. Price behavior becomes less predictable. These are signals that the environment is evolving. However, traders often remain anchored to their previous understanding. They continue to apply the same approach even as the market conditions shift. This creates a mismatch between strategy and environment, which leads to drawdowns. Recognizing regime transitions requires observation and flexibility. It involves paying attention to changes in price behavior, not just price direction. Are trends sustaining, or are they stalling? Are pullbacks shallow, or are they deep? Are breakouts following through, or are they reversing quickly? These questions help identify whether the current regime is still intact. Professional traders are constantly reassessing the environment. They do not assume stability, they expect change. This mindset allows them to adapt early rather than react late. Adaptation is not about constantly changing strategy. It is about adjusting application based on evolving conditions. That distinction is critical. One of the most practical ways to approach market regimes is through a structured framework. Rather than relying on intuition, you define specific criteria to assess the environment. This creates consistency in your decision making. A simple framework might include evaluating trend structure, volatility level, and macro context. Trend structure involves analyzing whether the market is making consistent directional progress. Are highs and lows forming in a clear pattern? Is momentum sustained? Volatility level can be assessed through price range, speed of movement, and frequency of reversals. Is the market stable or unstable? Macro context considers broader drivers such as interest rates, economic data, and global risk sentiment. By combining these elements, you build a clear picture of the current regime. This process does not need to be complex. What matters is consistency. You assess the same factors in the same way every time. This reduces emotional decision making and increases clarity. Professional trading is not about having more information. It is about having a better framework for interpreting information. Regimes provide that framework. Another important aspect of regime thinking is understanding that not all opportunities are equal. In certain environments, high quality opportunities are abundant. In others, they are scarce. For example, strong trending markets often provide multiple continuation opportunities. Pullbacks, breakouts, and momentum entries can all offer favorable conditions. In contrast, choppy, non-directional markets provide fewer high probability setups. Many trades become marginal with lower expected value. The mistake traders make is maintaining the same level of activity regardless of the environment. They feel the need to trade constantly. This leads to overtrading in poor conditions and underperformance. Professional traders adjust their activity based on opportunity quality. They trade more when conditions are favorable and less when they are not. This is a direct application of regime awareness. Trading is not about constant participation. It is about selective participation. Your goal is not to maximize the number of trades. It is to maximize the quality of trades. Regimes help you identify when that quality exists. Let's address a critical misconception. Many traders believe that mastering a strategy is the key to consistency. In reality, consistency comes from alignment between strategy and regime. You can have a highly effective strategy, but if you apply it in the wrong environment, it will underperform. Conversely, even a simple strategy can perform well if it is applied in the right conditions. This is why professional traders often use multiple approaches. Not because they lack focus, but because they understand that different environments require different tools. However, this does not mean constantly switching strategies. It means understanding when each approach is appropriate. You are building a toolkit, not searching for a single solution. Each tool has a specific purpose. Your job is to use the right tool at the right time. That requires awareness of the environment. Without that awareness, even the best tools become ineffective. Ultimately, market regimes redefine how you think about trading. You move away from the idea of certainty. You stop searching for perfect setups. Instead, you focus on alignment, context, and probability. You accept that the market is constantly changing and that your role is to adapt, not to control. This shift in perspective is fundamental. It transforms trading from a rigid, strategy-focused activity into a dynamic, context-driven process. You begin to see that losses are not just the result of poor execution. They are often the result of misalignment with the environment. And once you understand that, you gain a powerful advantage. Because you are no longer reacting blindly, you are operating with awareness. Market regimes are not an advanced concept. They are a foundational one. They sit at the core of professional trading thinking. And once you internalize them, every decision you make becomes more structured, more intentional, and more aligned with how markets actually behave. Once you begin to understand regimes, the next step is learning how to identify them in real time, not in hindsight. This is where most traders struggle because recognizing a regime after the fact is easy. Acting correctly while it is unfolding is far more difficult. Real-time identification requires you to focus on behavior, not outcomes. You are not waiting for confirmation that a trend exists. You are observing how price is behaving as it develops. For example, in a developing trend, you will often see a sequence: initial breakout followed by a controlled pullback, then continuation. The key is not the breakout itself, but the nature of the pullback. If the pullback is shallow, orderly, and lacks aggressive counter moves, it suggests that the dominant side remains in control. In contrast, if pullbacks are deep, volatile, and frequently erase prior moves, that is a signal that the market is not in a stable trending regime. This is subtle but critical. You are not just looking at direction, you are analyzing the quality of movement. Similarly, in mean reverting environments, you will notice repeated failures at extremes. Price pushes into a level, stalls, reverses, and moves back towards the center of the range. This behavior repeats multiple times. The key insight is repetition. One rejection does not define a regime. Consistent behavior does. Professional traders train themselves to recognize these patterns early, not perfectly, but early enough to adapt. This is not about certainty, it is about probability shifting in your favor. Let's go deeper into volatility, because it plays a central role in how regimes function, and more importantly, how you manage risk within them. Volatility is often misunderstood as simply how much the market moves. In reality, it is also about the structure of those movements. In a low volatility environment, price tends to move in a controlled, predictable manner. Swings are smaller and there is less noise. This makes it easier to define risk because your stop levels can be tighter without being easily triggered by random fluctuations. However, the trade-off is that profit potential per trade is often limited. Moves take longer to develop, and you may need to hold positions for extended periods to capture meaningful returns. In high volatility environments, everything accelerates. Price moves quickly, ranges expand, and reversals become more frequent. This creates opportunity, but also increases risk. The mistake traders make is applying the same risk parameters regardless of volatility. They use fixed stop distances, fixed position sizes, and fixed expectations. This leads to inconsistency. In low volatility, stops may be unnecessarily wide, reducing efficiency. In high volatility, stops may be too tight, leading to premature exits. Professional traders adjust dynamically. They scale position size based on volatility. Higher volatility means smaller size. Lower volatility allows for larger size. This is not optional. It is essential for maintaining consistent risk exposure. Volatility is not just something you observe, it is something you respond to. Another critical layer in regime understanding is time horizon. Not all regimes exist on the same time frame. A market can be trending on a higher time frame while ranging on a lower time frame. This creates complexity but also opportunity. For example, on a daily chart, a market may be in a clear uptrend, higher highs, higher lows, consistent momentum. However, on an intraday chart, that same market may be oscillating within a range. If you are a short-term trader, you might perceive the market as choppy and unpredictable. If you are a longer-term trader, you see a clear trend. Neither perspective is wrong. They are simply operating on different time frames. The mistake is failing to align your strategy with your time frame and the corresponding regime. If you are trading intraday, you need to respect the intraday regime even if it conflicts with the higher time frame trend. Conversely, if you are position trading, short-term noise should not dictate your decisions. Professional traders define their time frame clearly. They understand which regime they are trading and filter out conflicting signals from other time frames. This clarity reduces confusion and improves decision making. Regime analysis is not just about identifying the environment. It is about identifying the environment that is relevant to your trading horizon. Let's address the role of macroeconomic drivers in shaping regimes, because this is where many traders lack depth. Markets do not move in isolation. They are influenced by broader economic forces. Interest rates, inflation, growth expectations, and central bank policy all play a role in defining the environment. For example, a period of aggressive monetary tightening where central banks are raising interest rates often leads to a contraction in liquidity. This can create risk-off conditions, increase volatility, and reduce the sustainability of trends in risk assets. On the other hand, a period of monetary easing, where liquidity is being injected into the system, can support risk-on behavior, encourage capital flows into higher risk assets, and create more stable trending conditions. Understanding these macro drivers allows you to anticipate regime shifts rather than simply reacting to them. You are not predicting exact market movements. You are assessing how the underlying conditions are evolving. This gives you a structural edge because you are not just reading price action. You are understanding what is driving that price action. Professional traders operate at this level. They integrate macro context with market behavior. This does not mean you need to analyze every economic data point. It means focusing on the key drivers that influence liquidity and sentiment. Regimes are shaped by these forces. Ignoring them limits your understanding. Now consider the concept of regime persistence. Markets tend to remain in a particular regime longer than most traders expect. This creates a psychological challenge. Traders anticipate change too early. They try to call the end of a trend or the breakout from a range before there is sufficient evidence. This behavior is driven by the desire to be early, to capture the entire move. But in doing so, traders often position themselves against the prevailing regime. Professional traders understand that regime persists because the underlying drivers persist. Trends continue because the forces behind them have not yet changed. This is why trend following works, not because traders can predict the future, but because they align with existing momentum until there is clear evidence of change. The key phrase here is clear evidence, not assumption, not anticipation, but evidence. Until that evidence appears, the probability favors continuation. This requires discipline. It requires patience, and it requires the ability to resist the urge to be early. Being early is often the same as being wrong. Let's examine how regime awareness directly impacts trade execution, because this is where theory becomes practical. In a trending regime, your focus shifts towards continuation. You look for pullbacks, consolidation patterns, or breakouts in the direction of the trend. Your goal is to align with momentum. Your stop placement reflects this. You give trades enough room to develop, recognizing that trends include natural fluctuations. In a mean reverting regime, your approach changes. You focus on extremes. You look for overextended moves, areas where price is likely to reverse. Your stops are tighter because you expect quicker feedback from the market. If price does not reverse quickly, the premise of the trade is invalid. Execution is not just about where you enter, it is about how you structure the trade based on the environment. The same entry point can be valid in one regime and invalid in another, purely based on how the market behaves afterwards. Professional traders do not separate execution from context. They integrate the two. This is what creates consistency, not perfect entries, but appropriate execution relative to the regime. Another layer to consider is liquidity within different regimes. Liquidity is not constant and its distribution changes depending on the environment. In stable trending markets, liquidity is often more predictable. There is a clear flow of orders and price moves in a relatively orderly fashion. In volatile or uncertain environments, liquidity can become fragmented, gaps appear, slippage increases, and execution becomes more difficult. This has direct implications for trade management. In low liquidity conditions, large positions can have a greater impact on price. This increases transaction costs and execution risk. Professional traders are aware of this. They adjust position size, execution method, and even the instruments they trade based on liquidity conditions. This is particularly important during major economic events, geopolitical developments, or periods of market stress. Ignoring liquidity is a mistake because even if your directional view is correct, poor execution can erode your edge. Regime influences liquidity and liquidity influences execution. These elements are interconnected. Let's talk about the role of sentiment within market regimes. Sentiment reflects how market participants feel and position themselves. It is not always rational, but it is always influential. In strong trending environments, sentiment tends to reinforce the trend. Positive feedback loops develop. As price rises, more participants become bullish, which drives further buying. This can create extended moves, sometimes beyond what fundamentals alone would justify. In mean reverting environments, sentiment often oscillates. Participants become bullish at highs and bearish at lows, only to be proven wrong as the market reverses. Understanding sentiment helps you interpret market behavior more effectively. For example, in a late stage trend, sentiment may become extremely one-sided. This increases the risk of reversal, not because the trend is guaranteed to end, but because positioning becomes crowded. Professional traders monitor these dynamics. They do not trade based solely on sentiment, but they use it as a contextual input. Sentiment is part of the regime. It influences how price reacts to information. One of the most valuable skills you can develop is the ability to do nothing when the regime is unclear. There are periods where the market does not present a clear structure. Direction is inconsistent, volatility is unstable, and signals are unreliable. These are transitional phases. The market is shifting from one regime to another. During these periods, the probability of success is lower. Trades are more likely to fail, not because of poor execution, but because the environment lacks clarity. Amateur traders often see these periods as opportunities. They try to force trades, searching for signals where none exist. Professional traders do the opposite. They reduce activity. They protect capital. They wait. This is a critical distinction. Discipline is not just about following rules when trading. It is about knowing when not to trade. Inaction is a decision, and in many cases it is the correct one. So, as you integrate regime thinking into your process, you begin to see the market differently. You stop viewing trades as isolated events. Instead, you see them as expressions of the current environment. Every decision becomes conditional, not just based on your strategy, but on whether the environment supports that strategy. This creates a layered approach to trading. First, identify the regime. Second, determine whether your strategy is suited to that regime. Third, execute with appropriate risk management. This structure simplifies decision making, it removes ambiguity, it provides a clear framework for action. Professional trading is not about complexity, it is about clarity, and clarity comes from understanding the environment you are operating in. Market regimes provide that understanding. At this stage, it is important to bring everything together into a practical decision-making process. Understanding regimes conceptually is valuable, but the real edge comes from applying that understanding consistently. A professional approach begins before any trade is even considered. The first question is always the same: what is the current market regime? This is not a vague observation, it is a structured assessment. You evaluate trend behavior, volatility conditions, liquidity dynamics, and macro context. You form a clear view of the environment. Once that is established, the second question follows naturally. Is this an environment where my strategy has an edge? This is where discipline becomes critical. If the answer is no, you do not adapt the market to your strategy. You step aside, you wait. Most traders invert this process. They start with a strategy and look for reasons to apply it. Professionals start with the environment and determine whether action is justified. If the environment is aligned, only then do you move to execution. And even at this stage, execution is shaped by the regime. This creates a hierarchy of decisions: environment first, strategy second, execution third. When you follow this structure, trading becomes more controlled. You are no longer reacting impulsively. You are operating within a defined framework. That is what separates consistent traders from inconsistent ones. Not intelligence, not effort, but structure. Let's now consider how regime misalignment actually manifests in real trading behavior, because recognizing this in yourself is essential for improvement. One of the most common patterns is repeated small losses in choppy markets. A trader applies a breakout strategy in a non-directional environment. Price breaks out briefly, then reverses. This happens multiple times. The trader interprets this as bad luck or poor timing. In reality, the environment does not support breakouts. The losses are not random, they are structural. Another example is fading a strong trend. The market moves consistently in one direction, but the trader perceives it as overextended. They attempt to pick the top or bottom repeatedly, taking losses each time. Again, this is not a strategy issue, it is a regime issue. The trader is applying mean reversion logic in a trending environment. These patterns are predictable, and once you understand regimes, they become avoidable. Professional traders are not immune to losses, but their losses tend to occur within appropriate contexts. They lose while applying the right strategy in the right environment, not because they are misaligned. This distinction matters, because losses from misalignment are preventable. Losses from execution within the correct regime are part of the process. Understanding the difference allows you to refine your approach more effectively. Another important concept is the idea of regime overlap, where multiple conditions exist simultaneously, creating complexity in decision making. For example, you might have a strong macro-driven trend on a higher time frame, while short-term volatility creates frequent reversals on lower time frames. In this situation, both trend following and mean reversion behaviors are present, depending on your perspective. The key here is prioritization. You must decide which regime is most relevant to your trading horizon. If you are trading short term, you may focus on the intraday reversals, even if the broader trend is intact. If you are trading longer term, you may ignore short-term noise and focus on the underlying trend. The mistake is trying to trade both simultaneously without a clear framework. This leads to conflicting decisions, inconsistent execution, and confusion. Professional traders resolve this by defining their primary time frame and aligning their analysis accordingly. They are aware of other regimes, but they do not allow them to override their core framework. Clarity of focus is essential. Without it, regime analysis becomes overwhelming rather than useful. Let's explore how regime Awareness influences risk management because this is where it has the most tangible impact on performance. In stable, low volatility environments, risk can be deployed more efficiently. Position sizes can be larger relative to account size because price movements are more controlled. In unstable, high volatility environments, risk must be reduced. Even if the opportunity appears attractive, the increased uncertainty demands caution. This is not about confidence. It is about exposure. Professional traders think in terms of exposure, not conviction. They understand that high conviction in a high risk environment still requires controlled sizing. This is a critical mindset shift. Confidence does not justify risk. Environment defines risk. By adjusting exposure based on regime, you maintain consistency in your risk profile. You avoid large drawdowns during unstable periods and maximize efficiency during stable periods. This dynamic approach to risk management is a hallmark of professional trading. It is not static, it evolves with the market. Another dimension to consider is how regimes affect expectations. In a strong trending environment, it is reasonable to expect continuation. Trades can be held longer, targets can be extended, and patience is rewarded. In a range-bound environment, expectations must be adjusted. Moves are shorter, reversals are more frequent, and profits need to be taken more quickly. The mistake traders make is maintaining the same expectations regardless of the environment. They hold trades too long in ranges, giving back profits, or they exit too early in trends, limiting their upside. Professional traders align expectations with conditions. They understand that the market dictates what is achievable. This does not mean lowering standards. It means being realistic. Expectation management is directly linked to regime awareness. When you understand the environment, you understand what the market is likely to offer. Let's address the psychological impact of different regimes because this is often underestimated. Trending markets can create overconfidence. Success becomes easier. Trades work more consistently, and traders may begin to believe their skill has improved significantly. However, when the regime shifts, that confidence can quickly lead to overexposure and losses. Mean reverting or choppy markets have the opposite effect. They create frustration, self-doubt, and impulsive behavior. Traders may begin to question their strategy even if the issue is environmental. Understanding regimes helps stabilize psychology. You recognize that performance is influenced by conditions, not just your decisions. This creates emotional detachment. You do not overreact to winning or losing streaks because you understand the underlying context. Professional traders are not immune to emotions, but they manage them through understanding. Regimes provide that understanding. Now consider the importance of patience within regime-based trading. Patience is not simply waiting, it is waiting with purpose. When you understand that certain environments are not conducive to your strategy, patience becomes logical, not emotional. You are not sitting out because you are uncertain. You are sitting out because the probability is not in your favor. This distinction is powerful. It removes the feeling of missing out. It replaces it with control. Professional traders spend a significant amount of time not trading. They observe, they assess, and they wait for alignment. This is often misunderstood. Activity is not productivity in trading. Selectivity is. Regime awareness reinforces this. It gives you a clear reason to be patient, and when the right conditions appear, you are prepared to act decisively. Let's look at how regime thinking evolves as you gain experience. Initially, you may categorize markets in simple terms: trending or ranging, high volatility or low volatility. As your understanding deepens, you begin to see nuance. You recognize sub-regimes, transitions, and overlapping conditions. You develop a more refined view of the market, not as a binary system but as a spectrum of behaviors. This allows for more precise decision making. You are not just identifying the regime, you are understanding its characteristics and implications. Professional traders operate at this level. They see detail where others see simplicity. However, this complexity does not lead to confusion. It leads to clarity because it is structured. The key is to build your understanding gradually. Do not overcomplicate the process early on. Focus on the core concepts, then refine over time. Ultimately, market regimes are about alignment. Alignment between your strategy and the environment. Alignment between your expectations and what the market is offering. Alignment between your risk and the level of uncertainty. When alignment exists, trading becomes smoother, not easier, but more coherent. Decisions make sense, outcomes are more consistent, performance stabilizes. When alignment is absent, everything becomes more difficult. Trades feel forced, results are erratic, confidence fluctuates. This is not coincidence. It is a direct consequence of operating out of sync with the market. Professional traders prioritize alignment above all else. They understand that the market does not need to change. They do. The concept of market regimes fundamentally changes how you approach trading. You move away from searching for a universal solution. You accept that different conditions require different approaches. You begin to see the market as a dynamic system, not a static puzzle to be solved. This perspective brings clarity. It removes the illusion that success comes from predicting the market. Instead, it emphasizes adapting to it. You focus on what is, not what you think should be, and that is the essence of professional trading. Not prediction, but alignment. Not certainty, but probability. Not rigidity, but adaptability. Market regimes are the framework that makes this possible. Once you internalize this, every decision you make is grounded in reality, and that is where consistency begins.